Okay, I've got that it is 7 o'clock, and I want to thank everybody that's given up their time today or their evening, Tuesday evening. We like to do this every Tuesday. We're going to have some kind of presentation. I'm going to try to run through it quickly. I don't want to keep you for very long. I do want to provide good information for you. My name is Mike Durr. I am the Kingwood Mortgage Guy. I guess I'm the Kingwood Mortgage Guy because I live in Kingwood and I've been in the mortgage business for the last 20 years. Today is not January the 19th, January 26th. Today, we'll change that. If you have any questions after the webinar, you can call me at 281-348-9899. Nation's Reliable Lending is the company I work with. And this subject is something that's going to be interesting to a lot of people. I go over this information with a lot of people individually. Tonight, I'm going to go over it with a large group of people. And the premise of this is to raise your credit score 40 points in 45 days. Now, before I get started, I just got to tell you a quick little story. I had a couple meet with me this last weekend, and I'd met with this guy initially back at the 1st of August, 2015. So it's basically been four and a half months since then. When we initially met, his FICO score, his middle score was right at 600. He had a couple 500s or 580 something, but his middle score was, I think, 605. And 605, you can do a mortgage loan with a 605, but it's hard. I mean, they really scrutinize those things. During the course of our meeting back in August, I gave him some strategies, not dissimilar from what you're going to get tonight. He implemented those. He called me about 2 weeks ago. He said, Mike, I've done what you told me, and I don't know, I haven't checked my credit, but I think I've done some good things, or at least if the things that you told me are the right things to do, then I should be in pretty good shape. Well, sure enough, him and his wife came in, and this was this Saturday. I guess that would be the 23rd of January. And when we pulled his credit, his FICO score had gone from 605 to 675. So 40 points in 45 days is realistic. I've actually seen it go higher. It just depends on where you're starting from and what's going on with your credit. But I would take 70 points anytime over a 4-month period. And that's all that's to say is that the credit scoring mechanism is something that you can tweak, you can manipulate it, you can work with it, and you can make, if you know what they're looking for and you have the means to do what you need to do, then you can make your credit score better. Now, credit is not a good thing. I mean, it can be a good thing. It's like a tool. A lot of people tease me that when they see me with a hammer, they want to stop me because they know something's getting ready to get broken. And the one thing I am good at in demolition or in home work type stuff, home handyman things, is tearing stuff up. I mean, I can do it with the best of them. If I'm to create stuff, that's not my good thing. Well, credit's kind of the same way. Credit is something that you can use if you use it prudently and you use it intelligently. And that's what we're going to do today. We're going to talk about it. So as we go through this, I'm going to just go through these slides, and then I want you to hold your questions to the end, or if you want to put them in the chat, I'm not going to look at the chat really until the end. So we'll get through this. So what is credit scoring? Well, the definition is the use of a statistical risk assessment model, which uses consumer reporting agency information to significantly increase the level of predictive power to determine good payers from bad payers. So what they're trying to do is they're trying to figure out who is going to be paying them in the manner that they accept and who are going to be the bad payers. And there are people that have tendencies that they tend to forget, or they are lazy, or they just have bad intent on paying their bills. And what this scoring mechanism has tried to attempt to do is to predict that with a measure of success. So going on to the next slide, I want to tell you, and I like this slide a lot, actually. See if I can get it to work. There you go. Old school scoring. Well, let's see. I don't need this. There we go. I get this. There we go. No, didn't go out. Okay, old school scoring. Now, when I got in the mortgage business, this is what we used to do. What we would do, if you were a mortgage company and you were thinking about extending credit to somebody, what you would do is you would look at how they paid their rent or look at how they paid their other credit. Now, you'd use the rent or a previous mortgage as the primary focus, and then you'd look at other installment debts like car loans or like anything that you would get an installment on. And then credit cards were considered in the third category, and we gave them a lesser weight than we did installments. And of course, the mortgage we gave the most weight. So what we would do is we'd count the number if they'd had late payments in their mortgage payment, then they were in pretty good jeopardy. If they had lates in their installment debts, then it was a problem, but it wasn't a big problem. And we really didn't even care how they paid their credit cards because we just didn't think that they were that important. Now, today, that's completely switched. I mean, it was time consuming to score a credit report. And today you just do it. I mean, the machine, the algorithm does it for you. And is it always predictive? Well, it's not always, but it's pretty darn good. I mean, they've adopted it. They feel pretty good about it. Don't you love this picture, though? This is definitely old school. And look at the people all, anyway, I'm going to get away from that. And so anyway, credit cards are unsecured. This is one of the things that's going on and why this system came about. The credit card lobby, the people that have credit cards, they needed some way to figure out how to figure people that were going to pay them and people that weren't. And if you don't pay your house payment, well, what happens? Well, they will take your house away. I mean, they'll come and foreclose on it. It's the same thing. If you don't pay for your car payment, in the middle of the night, somebody's going to come out there and they're going to pick up your car and drive it away because you didn't pay for it. You don't get to keep it. It's a secured debt. The collateral for that debt can be taken away. Well, on credit cards, it's unsecured. In other words, there's nothing specific that they can attach and take back. Thus the reason that the credit card lobby and the people that own credit card companies, banks and stuff like that, they said, we've got to have a better way to have some leverage over the people that are choosing not to pay us. And that's when they came up with the scoring mechanism. And I don't think that they even imagined how broadly this information would be used when they initially came up with the scoring mechanism. But the truth is, what it predicts is it predicts the likelihood of going 90 days past due. And so if you have a low score, the chances of you going 90 days past due are high. And then as your score goes up, it just gets a lot less chance that you're going to go 90 days past due. So that's what they're trying to do. Now, scores are dynamic. This is an important thing, is that when you get a score, it's a snapshot of a consumer's credit profile at that particular point in time. And so the key thing that you need to recognize about that is credit can change fast. I mean, it gets input from these creditors. The creditors send their information on how you paid your bill up to the credit reporting agency. You'll see this in some of the slides later. A CRA is a credit reporting agency. And when that input or that data goes into the score, the algorithm does its magic, and your scores change as soon as that information is put in there. Thus, one of the reasons that we think it's very possible, and we've seen it happen a lot of times, is within a day or two, a couple things can change, and it will make a huge difference as to what your score could be. So the score represents a summation of risk of repayment of a debt by a consumer based on the CRA, the Consumer Reporting Agency's credit profile for that consumer, as it is ranked against the profiles of all other consumers with credit reported and stored within that specific CRA files, much like a bell curve. So what you're being judged on, this is kind of interesting, is that you're being judged on your credit compared to everybody else's credit. So if you're doing really good, then you know that you're in the elite group, but there are people that kind of don't do so well, and they kind of push up the half there. So anyway, score represents kind of interesting how you're looked amongst the group. Now, one thing, I think it's in here, but I'm going to go ahead and tell you, there are three main credit reporting agencies. There are Experian, they're Equifax, and they're TransUnion. So when it's talking about on the CRA's credit profile for that consumer as it ranks against the profile of all the other consumers with credit reported to that particular credit reporting agency. So that's what that means. Okay. Oh, don't go. All right. Each bureaus are different. Why don't the scores at each credit reporting agency agree? Well, anybody have an idea? Well, they're different companies. They have they like to tweak their scoring mechanism a little bit, and they also have a different bias. Plus, there are more than just one scoring mechanism for each bureau. Each bureau may have a multiple different scoring. I'll give you an example. As a mortgage company, we really care and want the main emphasis to be on mortgages or how mortgage payments are paid. So we might have a bias that if you don't pay your mortgage, your score would go down a little bit lower. Now, that works for us, but if you are in the auto finance business, then you might care less about how they pay their home and a little bit more about how they pay their cars. And so they might tweak that up a little bit. So you could have a mortgage scoring mechanism or algorithm. You could have an auto scoring algorithm. You could, and of course, the credit cards have their own scoring algorithm. So when you you could have your credit pulled by 3 different people in the same day, and you'd get different scores on all of them based on the different model that they used. Now, the next question on here is which score is used? Well, I can't really speak to the auto or the credit card industry. A lot of times the credit card industry will only pull one bureau. We pull all 3, and we use the middle one. We don't average them. It's not an average. It's just whatever one falls in the middle, that's the one we use. So I explained the different industries and the different scoring models within it, so I kind of jumped on that one. All right, so this is kind of the point where we go raise your credit score 40 points in 45 days. Is that possible? I can tell you absolutely is. I've actually changed this. I used to say raise your credit score 100 points in 45 days, and I've seen it happen. It can happen, but I don't want to give you false expectations. This is very doable once you understand how it works. Okay, we're going to go through a little bit about what makes up the credit score. And this is going to surprise you a little bit, but the payment history, I don't think is any surprise to anybody. 35% of your score is going to be based on how you pay your debts. How you pay, your payment history. That makes sense to me. That's one of the few things in this part that actually does make some sense. So if you don't pay very well, that's going to represent 35% of your score. Now, balances carried. This next one here talks about the balances carried, and it's really the balances carried on revolving credit card loans, not so much the balances carried on installment debt or even mortgage debt. Has much less effect on installment debt and on mortgage debt. The balance carried is a big deal though in the credit card industry, and we're going to go through a detailed explanation. I won't go off on that tangent right now. Now, credit history, and what it's talking about here, it's not the same as your payment history. Your credit history is the length of time that you've had credit. So how long have they had a chance to really evaluate how you're going to go over, excuse me, over a longer period. The longer the period they have, the more comfortable they feel that they're going to make a good decision. And then I think my thing right here, let's see, we're going to move that. There we go. Mix of accounts. They like to see that you've got a mortgage. They like to see that you've got car debt, and they like to see that you have 1, 2, or 3 credit cards. So they like to see a mix of accounts because they want to see how you handle the package of those things. And then finally down here, it's got 10% on inquiries. And I think that actually, from my standpoint, inquiries may be less than 10%. I would first think, well, for younger people that don't have a very long credit history, inquiries may be a little harder or a little more of a factor of their credit score, but I don't think so. So anyway, these are the 5 key things that is what makes up your credit score. Okay, payment history, we're going to talk about that. Bills paid as agreed. Guess what? The credit algorithm loves bills paid as agreed. They look back at the most recent 6 months. Now, this is one things I explain a lot to people. Credit scoring and credit derogatories, when you have a derogatory, that means you didn't pay. Let's say that you missed a payment. And for the next 6 months, that's going to really negatively affect your score. In that 7-month, the amount that it hurts your score is going to diminish a little bit. And then over the course of the next 18 months, it will diminish a little bit each month. When you get to the 2-year point, that negative credit, that negative report, that derogatory that you had, doesn't really hurt your credit too much. So the first 6 months is the worst. When you get to a year, there's a lessening of it. And then that second year, it lessens each month to the point where you get to the 24th month and it's really not hurting you much at all. Okay, so if you do have a negative credit hit or a derogatory or a late payment, don't get too excited about it. It's not the end of the world. You're going to recover from it. Now, it's a long recovery, but it's still you're going to recover from. The highest weight is on the highest pay history. So an example is a mortgage is usually the largest debt that you have or the biggest payment that you have. So they do weight that, and particularly if you miss a mortgage payment, it's pretty brutal as to what's going to happen to your credit score. It could drop 100 points, but actually the same thing could happen if you missed a credit card payment. All right, I call this one credit card mastery, and my standard recommendation to a lot of people that are having credit issues is usually to get a credit card. And I know Dave Ramsey would just kind of kick me right in the backside when he heard me say that. But it's a fact that if you need credit, if you're going to try to buy a house, you need to have credit scores. And there may be some lenders out there that don't require credit scores, but they're not very many. And you'll have a much easier chance of getting a home if you have credit scores. So here's the standard scenario. Somebody runs into a rough patch. They have some kind of credit trauma. It could be lost their job. They could have got sick. They could have had a divorce. They could have had one of those things. And what they do is they tend to retreat after they've had trouble paying their bills. They retreat from credit. They might have applied once and they got turned down. They said, you know what? I'm unworthy to have credit. And they just quit going out and getting credit. And what they do is they operate on cash or debit cards. And in our economy, we can do that. It's not hard to do to operate on cash, your paychecks. And guess what? It actually builds up a good practice for doing that because it's not necessarily a bad way to go. They've learned that the credit was kind of like a siren, and it was lured into buying or spending more money than they could actually afford, with the result being when you couldn't pay your debts, it was embarrassing, it was painful. I mean, it was just really a big hit on your ego. It's just a bad thing. So what happens is they eliminate using credit cards. They don't have hardly any debt. They may have a car loan because they had to. They're renting somewhere. And there's nothing that's going on in their credit report except the bad stuff from when the trauma happened. And I can tell you this happens all the time, is that the people that come to me with bad credit usually haven't had credit for a year or two, maybe longer than that. And really what it is, it's all about getting back some positive stuff going again. And that's why I call this credit card mastery. So that was a long explanation, but I'm going to explain how this works. It says here on the first line, keep balances as low as possible. So what's going to happen when you get a credit card? You get a limit. And it might be a $500 limit. It might be a $200 limit. It could be a $10,000 limit, depending on how your credit scores are. If they give you a $10,000 credit limit and you go out and spend $9,950 on that credit limit, you're in jeopardy. Well, what you're doing is you're scaring the credit card company. And they get nervous when you go above 50%. So here's what happens. If you keep your balance at around $1,000 and you've got a $10,000 limit, they feel pretty darn good that you're using your credit in a manner that they feel is responsible. Now, when you go and you do 9,950, it scares them. And here's why. There was a statistic that showed that a high percentage of people that went into bankruptcy, right before they went into bankruptcy, they ran their credit cards up to the limit. And so what the credit card algorithm interprets that as is when people have high balances on their credit cards, they're pushing the limit, they're in trouble. And it's not hard to get to the top limit. I mean, you pay the minimum amount and you spend more. You pay the minimum amount and you spend a little more. Well, next thing you know, you're at the maximum limit. So in this particular case, what I did is I've got one guy, he likes one particular card, and so he uses the one card, and it may be because the interest rate on the other card is a little bit higher. It could be whatever reason. So he's got two cards. He's got $10,000 limits on both of them, but he's putting all his charges on one card. So he's being negative or being affected negatively on his credit score because of that. Now, if he's got a $10,000 limit and as long as he can make his payments, he may not care. But this is a webinar designed for people that do care about whether their credit score is higher or lower. So here's what you need to do on that. What you might do is you might say, okay, first off, at 50%, or in this case, $5,000, if he owed $5,000, he wouldn't have points taken away from him and he wouldn't have points given to him. He'd be at par. As he gets below 50%, his credit score starts going up. As he goes above 50%, his credit score starts going down. Now, does that make sense? So the higher balance that you have against your limit, over 50%, it is negatively affecting your credit score. And as you go below 50% of the limit, it positively affects your credit score. Now, what we found after a lot of research and study, we feel pretty comfortable in using this term, that you get the maximum amount of points when your balance is about 10% of the limit. In this particular case, on a guy with $10,000 limit, if he had a $1,000 balance, he would get the maximum points. One of the things, a lot of people, when they get a credit card, they pay it to zero every month. Well, if the credit reporting agency gets a report and it shows that you've got a $10,000 balance and your balance is zero, do you get points for that? You'd think so. Most people think that they're paying their credit perfectly. They're just like the ideal payer. Well, the credit card companies don't seem to like that. And when you have a zero balance against any kind of limit, you get 0 points. And don't ask me why. I've had people argue with me about it, but it's just what my perspective is on how the credit card industry is. And it may be a little sinister. It may be that they want you to be charging. You know, they want to have some money coming in. Maybe that's the reason. I don't know. But you can see on this particular case, this guy could make some adjustments. He could actually pay this down a little bit and then split the two cards, have them both below 50%, and it would help his credit score. You know, the ideal, and if he's going to have that much debt on credit card, he might not want to keep that much. You know, you'd want to pay that down and get it down to $2,000 or $3,000. Then all of a sudden you're operating in a much more comfortable place for the credit card and for yourself. So anyway, that was a long industry, but we spend a lot of time on credit cards and how to use those. So credit history, longer credit history equals higher credit score. They like that. They feel more comfortable in interpreting how you are doing on there. Long credit paid as agreed, positive impact to your credit score. Never close credit card accounts. I say that. When I say this, it's all related to keeping your scores up. When you diminish your capacity to take credit on, you hurt the chances that the credit you have. I mean, they not only use each card as, you know, the limit and the balance, but they also use all your credit that you have. So if you have 3 cards and you kill one of them, then you've diminished your credit capacity, which makes it harder to have your score positive again. So we encourage you, when you're trying to build your score, never close credit accounts. Now, if you don't care about your credit score, go ahead and kill them. I mean, you know, especially if you've got a long history and you just don't need it and you're worried about the security of it or ID theft or something like that. But just know that it potentially could hurt your score. Okay, best chance. Ideal, best chance, what that means is best chance to have a higher score is to have installments and revolving accounts. So this is the mix, a mortgage loan, an auto loan, 3 to 5 credit cards, and more is okay too, as long as you handle them properly. You got to be careful about home equity lines of credit, because if they're less than, and this may be an old slide, but if they're less than $40,000, they will report as a revolving account instead of a mortgage. And if they do that, then you know, particularly if you're have $35,000 on a $40,000 line, the capacity would be pretty tight and it would be negative on you. Okay. History and mix. You don't want to have a short history and have a lot of credit cards. So that would scare the credit card industry or the algorithm, because you've got a lot of credit and you don't have a lot of history that they can see how you've done. So you want to be very careful about that when you're young and you get offered all these credit cards. Just be careful, be cautious, be a little conservative if that's the case, and you'll kind of grow this thing very comfortably. Short history and over 8 revolving lines of credit or cards could be a problem, and it may be a problem just handling them. I mean, I've got 2 or 3, actually I think I have 4 cards now, and I use 3. Just managing those is something that, I mean, I don't think I could do a lot more than that. All right, so what we're going to do is we're going to take a look at a credit report, and this is an old one. This is from a past gig I used to have, but this guy's middle score is 512. Now, he's not going to get a mortgage loan today, chances are, but I'm going to show you a couple things on here, and I redacted a lot of it. He has tax liens on here, even though it's released. These are all released. He's got a tax lien in Harris County. And then the rest of his score, here's his option 1 mortgage payment. And what it shows in this 30-day column is he's been late several times in January, February, June, July, September, and then in November. So he's had a rough year. Now he's caught up. You know, he keeps hanging in there. He doesn't have a 60-day late, but he's struggling a little bit. Now this Washington Mutual says here it's a revolving card. Okay, and he has, last time it reported, it looks like, was 12 of 06. He's had a late in 9 of 06, a late in 10 of 06, and in 12 of 06, 11 and 12. And look at this. His limit is $10,907. And his balance is $10,907. And it looks like maybe his high limit prior to that was $92.38. So this guy is actually over his limit. And credit cards will allow you to do that. And boy, they throw on the interest rate like crazy. I mean, this is loan shark interest rates at this point. But this is killing his score. And I'm telling you, the credit card company is scared to death that he is going to go to bankruptcy. Now here's a different one. This is actually an installment on the car, and no, but he's paid his car good. You know, he knows he's got to get to work and stuff. Here's another install. It pays this one good. That's probably his wife's car. He's paid that one pretty good. This is 0 down auto install. He pays his cars good. You just got to give him credit for that. I mean, if I was a car dealer, I'd sell this guy a car. Now here's his credit card again, and it's kind of a similar thing. It's the Capital One Bank. His high balance is 6810, and look at his balance. It's 85. So he's probably 95, 97% of his limit on his balance. And again, and here's the same thing. He's got 6406 against it's a $7,200 high limit. So he's well into the 90% range. Here's another one, 4836 or $5,000 limit. He's at 4600. So this gives you a good idea. Same thing here. He's at the height of every one of his credit cards, and he's had some late payments on his mortgage and on this particular, whatever this one is, this credit card. So he is struggling, and this will win you 500 FICO scores. I mean, this is just the way it works. Okay, now we're going to look at a good one. In this particular case, this guy's 796, 794, 785, and you're going to see this. Again, he's got a perfect, let me go here. He's got a perfect mortgage history. Here he's got another, I guess he's got another mortgage. We've got a couple mortgages down here. And then here's another mortgage payment. So he's got a couple different mortgages, but I guess when you've got 780, 790 FICO scores, you can do that. Here's his credit card, and he's got a $3,500 limit, and he's got a $151 balance. Now that's about 5%, and they like that stuff. He's got a $4,000 limit, and he's got a $137 balance. So this is how they want you to use your credit card. Here he's got $7,500 limit. He's using $56. So you can see the difference, why you have 790, 800 FICO scores when you use credit in a very light way. So that's what you want. All right. One of the big questions I get is when you're shopping for a mortgage, and probably even more so when you're shopping for a car. Multiple pulls on your credit report. How does that affect you? And I'm not sure about other industries, but I'm pretty confident that the information I'm going to give you on the mortgage industry and in the auto industry is the same. It's not unusual for you to go get find somebody to pull your credit on as a mortgage company, and the credit bureaus know what type of company is pulling your credit. It's not just all, they're segmented, so they know when a mortgage company pulls your credit. And after that first pull, you can have, for the next 45 days, you can have as many people pull your credit without any effect. It will count as one inquiry, and really you only, after 10 inquiries in a year, that's all they count. They don't count more than that. So when you're shopping, they don't want to, they changed this because they didn't want to discourage you from shopping for the best loan. And it's the same thing in the auto industry. It's not unusual for you to go to the Chevy dealer and then go to the Honda dealer and then go to the Volkswagen and then go to some other dealer. At each one of them, you might have had your credit pulled. Now, I'm not sure that's the ideal way to do it, but you may have done it that way. And just know that first pull, you get an inquiry. The other ones after that, at least for the next 45 days, does not affect you. Soft credit pulls. There are credit pulls that don't hurt you at all. A lot of times, the company that you work for can pull your credit. Insurance and utility companies can pull your credit. Maybe an account review if you have a credit card and you want to raise your limit, or they're just doing a routine review of your credit, what your balances are, that kind of stuff. These all do not count as inquiries on your credit. And then I don't know if you can see this, but the one thing you can do to find out what your credit score is, and I'm going to give you this one, is annualcreditreport.com is a free credit report. Now, when you do that, you can count on getting some pre-approved offers in the mail because they do share that information. I also share with you on this webinar that if you are in the market for finding a house and you'd like to know what your credit is, I will do that also for free. I'll pull a tri-merge account and I'll do it for free. Obviously, if you're just doing it and you're not looking for a house, I'd rather not spend the money for it. But if you're serious about buying a house, I'd love to help you with that. I never charge for credit reports. So blemished credit can be costly. So why in the heck do we worry about our credit score? Well, guess what? When you have a lower credit score, some people will extend you credit, but when they extend it, they put what's called a risk factor on there. And the risk is to them. So when they have risk, they raise the rate. They're going to say, I may lend you credit, but if I'm going to lend it to you, I'm going to charge you more for it. And so how that works is, guess what? If you're going to spend $200,000 on a house and you're paying 0.5% more interest than somebody else, you're paying more than you would need to for that house. It's the same thing on a car. I mean, some cars are very expensive, and if you pay, you can get a car note these days 1.5%, 2%, but you may be paying 8 or 9% because your credit score is not very good. Credit cards, they charge more for people that have lesser or for higher scores, or they charge less interest for people that have higher scores. They charge more for people that have lower scores. Insurance premiums, you may not even be able to qualify for insurance because you have bad credit. So these things can make a big difference. And if you have tough credit and you're trying to get or tough credit scores and you're trying to get a loan or a car or all of the above, guess what? You end up paying $200 or $300 more for the goods, the things that you need, than somebody that has good credit. And it's like a penalty. It's like a tax. And so what you want to do is you want to seek to have better credit scores if you're going to be in this credit world. So what is good credit? Well, good credit is 740 in the mortgage industry. When you get to 740 and above, you have no risk hits. I spoke of risk hits. At 739, you have a small hit. So it's 1 point difference can make it a small hit, and there is a small factor in your rate. And they go every 20 points in the mortgage industry. I don't know about other industries, but at 739 you get a hit, at 719 you get a hit, at 699 you get a hit, at 679 you get a hit, and if you go below 660, chances are you're going to be ruled out of conventional loans or most of the good credit conventional loans. So that's for our mortgage industry. Okay, so do these things now. These are some of the things that you can do that help your accounts. Pay all accounts that are past due. Now, I'm going to temper that a little bit because if you have open accounts that are past due, 30, 60, or 90 days, then you need to pay them. You need to get them caught up. I talked with a young man today, and he has some student loans, and they're just, they're 90 days, 120 days past due. And the one negative thing about student loans is they don't ever go away. I mean, it's the government that is issued those or is guaranteed those, and you will not be able to function with those student loans on there. They'll get you some way or another. If it's other types of account, one of the things that I tell people all the time is to have somebody look at it that knows how to read credit, because there are actually some things that are more important to pay than others to help you build your score. And I'm going to stop right there and say, if you've incurred the obligation, then you should pay it. Okay, that's just doing what's right. But when we're trying to build your credit and you have money to pay some of your creditors, some guidance as to who you pay first to get the maximum impact for your money so that you can do what you want to do, in this case, hopefully buy a house, it would probably be smart to use that strategically. Past due accounts, this is a killer. 1 day late, okay? You pay your $10 credit card payment 1 day late, and your score can drop 60, 70, 80 points just because you missed this 1 day and it's reported late. So you have to be very careful. You can't be sloppy. You have to know what's going on with that. Past due accounts do not include judgments and collection accounts. And again, if you have those kind of things, I encourage you to talk to somebody like myself that knows how to read those and also understands the goals that you're trying to, what your goals are. All right. Have late payments removed. Well, this is something that you can do on your own. There's a lot of things that you can do by yourself. There are some things that you can't. But I always encourage you to phone the creditor and request to have the late payments be removed, particularly if they're like that one I just talked about, where it's a $10 payment and it was late 1 day. A lot of times they'll help you. Now, you may not be able to get help from the first person you talk to, but I encourage you to be persistent and work your way up the ladder as far as talk to supervisors. And if after one supervisor, talk to another supervisor and just be persistent. Always get a letter that documents the name, address, account, specific late to be removed on company letterhead signed by the employee. So if they agree to do that, you want to get it from them in writing. Otherwise, a lot of times things just don't happen when people just say them. So you want to verify, and that's consistent on any kind of paying debt or getting things caught up. You just want to have your ducks in a row. All right, here's some tips. Every 6 months, request an increase to a credit limit on a credit account. Now, it doesn't hurt you if you're used to spending $1,000 on a credit card. It's okay to have a $2,000 limit, but it's better to have a $5,000 limit because it's going to help your credit score. And all you've got to do is resist the temptation to spend that extra money. So it's a twofold thing. You got to have the discipline and resist that temptation. But if you do that, it expands your capacity, and capacity is a good thing. Have creditor base increase on your credit history. So if you're a good payer, say, dude, I've been paying you like clockwork. I keep my limit down. I think I deserve that. And sometimes they will. I also encourage you, if they're going to pull your credit, I generally don't allow them to do that. If it's just for my convenience, it's not a big deal. Okay, here's something that still works. Ask a relative or a friend to add you to their credit account. This is called a authorized user. And authorized users do get some credit for somebody else's good credit. And an example would be, say you have a parent that has a $10,000 or $15,000 limit with a credit card that they've had for 35 years or 20 years or whatever the number is. They've had it for years. They've got a long history. They keep their balance low. They pay their bills on time. You would benefit just by being a user. Now, this is not asking your parents or this person to give you a credit card. They're never going to give you a credit card. Don't even ask that. But for you to be on their account, have your social security number on their account, you would get some of the benefits of being on there as an authorized user. Okay, it's a good idea. It's a good tip, particularly if you're having trouble getting a card. Confirm the following items. You want to make sure that you don't do that with somebody that does spend more than 50% on the limit. And like I said, no risk, as credit card does not go to, they don't give you a credit card. So that's an authorized user. That's a very good way to go. Keep all accounts open. I think we talked about that. Use old accounts periodically. Charge a small amount. In fact, go out and take your spouse to McDonald's and use it, or pay gas one time a month just so you can keep it active, because they'll close account and it will hurt your score. So you want to keep the account you have. And again, I suggest 3 to 5 max, but use those consistently. Don't let them just go dormant. Consumer disputes. So CRA, Consumer Reporting Agency, does research and verify. So if you're going to dispute something, you got to have some backup. If you just dispute it and then don't have proof or any backup, you can bet that they're not going to honor that dispute. So when you're going to dispute something is when you have some facts, some data, something that you can send to them. You contact the furnisher of a credit info with any evidence. So it's a big deal. The consumer to direct to furnish of credit information. Consumer sends notice of dispute with evidence, and the credit furnisher changes reporting to the CRA. An example of that, I'm working with a client right now that has paid off a judgment. The judgment right now shows as still being open, and we've got evidence that this has gone to the courthouse, it's been released, and I've just got to send this to the credit reporting agency. They'll confirm it, and then they'll remove or say that that judgment has been released. So you got to have documents when you do this kind of stuff. Summary: do these things. Borrow. If you're going to borrow, do it when you don't need it. That's when you're most likely to get the money. Keep the balance to limit ratio low. So 20, 30%, I don't encourage you to go much over 30% if you can help it. When a creditor removes late and provides later, use credit rescore. We rescore all the time when things change. It could be balances change, when people remove stuff. So credit rescore is a really good way and a fast way to get things changed. Consult with your mortgage professional before you consider paying off a collection or judgment when applying for a mortgage loan. I can't stress this enough. This is not intuitive stuff. Sometimes doing something like that can actually negatively hurt your score. Even though it seems like the absolute right thing to do, I encourage you to talk to somebody before you do it. Don't waste that money when you're not going to be helped by it. Increasing credit score by 10 points, you get interest savings. It could make a big difference. I mean, thousands of dollars difference, particularly on a mortgage or a car, just by increasing your score by 10 points, if it's the right 10 points. So there's a lot of cool things that you can do if you have better FICO scores. So I've rambled on for the last 43 minutes, and I haven't even looked at the questions there, but I want you to know how your credit scores can affect your life, and they can help you a lot if you pay attention. And if you have any questions, I want you to feel free to call me. This is Mike Durr. I am the Kingwood Mortgage Guy. My number is 281-348-9899. If you go online or you go to YouTube and you search Mike Durr, you're going to find I do a lot of videos, and it's mostly related to mortgage stuff, a lot of credit stuff, and I'd love to help you. So that's it for tonight. I thank you so much for being here. Hopefully this information has been helpful, and with that, I'm going to sign off. And next week, if you see this, I'm going to be back here on, I guess, whatever, the first Tuesday in February, and we're going to be talking about something different. So talk to you soon. Bye-bye.